In today's economy, some of the most valuable things a company owns are things you can't even see or touch. We're talking about secret formulas, killer brand names, game-changing software. That's the world of intangible assets, and today we're going to make that invisible value visible. So let me kick things off with a question for you. What do you think a brand logo, a patent for a new medicine, and your favorite app all have in common? Well, the answer is actually pretty mind-blowing when you think about it. They can be worth billions, literally billions of dollars, and yet you can't physically touch a single one of them. It's pure value floating right there in the abstract. So here's our roadmap. We're going to follow the journey of an idea. We'll start with what an intangible even is, then see how it actually becomes a real asset. After that, we'll get into the critical battle between research and development, figure out how you put a price tag on it, and finally, wrap up with why all these rules matter so much right now. Okay, let's dive in. To really get how companies handle these invisible powerhouses, we have to start with the basic rules of the game. So, what actually makes something an intangible asset in the world of accounting? The official definition sounds a little dry, I know, an identifiable non-monetary asset without physical substance. But trust me, once you break it down, it makes perfect sense. It really just boils down to 3 simple tests. First, it's got to be identifiable. That means you could, in theory, sell it or license it, or it comes from a legal contract, like a patent. Second, it's non-monetary, pretty obvious, it isn't actual cash. And third, the big one, it has no physical substance. You can't exactly stick a brand name in a storage unit, right? But here's the thing. Just because an idea fits that definition doesn't mean it automatically shows up on the books. To make it onto the official balance sheet, it has to pass this really important gateway test. And this test has 2 key hurdles, straight from the accounting rulebook, IAS 38. First, is it probable that this thing is actually going to make you money in the future? And second, can you reliably figure out what it costs to create? If you can't confidently say yes to both, it doesn't get to be called an asset. Simple as that. And this leads us to what is maybe the most important concept of all for companies creating their own stuff. This is the moment, the crucible, where a fuzzy idea gets forged into a hard asset on the balance sheet. I'm talking about the split between research and development. Think of it like this. The research phase is all about exploration. You're just looking around, trying to discover new things. It's super uncertain. And because it's so uncertain, any money you spend here is an immediate hit to your profits. It's an expense. But the development phase? That's about application. You're taking what you learned and building a real product. The costs here can be capitalized, which is just a fancy way of saying they get bundled up to create the value of a new asset. And the rules are incredibly black and white on this. IAS 38 puts it bluntly. No intangible asset arising from research shall be recognized. Any money you spend on research has to be recognized as an expense right away. No ifs, ands, or buts. Let's make this real with a quick story. Imagine a company has this brilliant idea for a tiny micro freezer. In the very early days, they're spending money on things like market surveys, just trying to figure out if anyone would even buy this thing. This is pure pie-in-the-sky exploration. So it's all research, and every cent they spend is an expense that lowers their profit for the year. And then you get the turning point. After messing around with some prototypes, on one specific day, September 30th, the engineers finally confirmed that yes, a final design is technically possible to build. That one confirmation, that single moment, changes everything. The project officially flips the switch from uncertain research to viable development. So from this day forward, the whole accounting game changes. All the money they spend on designing the final version, building a test model, and putting it through its paces, that's no longer an expense hitting this year's profit. Nope. Now those costs are being collected and capitalized, building up the value of a new microfreezer asset right there on the balance sheet. And check this out. This table just lays it all out perfectly. That $240,000 spent before that key date, gone. Expensed against profits. But the $1.7 million spent after they knew it was possible, that became a brand new asset, showing the company created something of future value. Okay, so now the company has this shiny new $1.7 million asset on its books. But the story doesn't end there, right? How do they account for its value over time? What's the price tag in year 2 or year 5? Well, the rule for day 1 is super straightforward. The asset's starting value is simply what it costs to make. For our microfreezer, that's the $1.7 million in development costs they capitalized. That's its initial value, period. But assets don't last forever. You know how a physical machine depreciates or wears out? Well, the same idea applies to intangibles, but it's called amortization. It's basically the exact same concept. You're just spreading the cost of the asset over its useful life. It's depreciation for things you can't touch. Now, after that first day, companies have a choice to make. They can use the simple cost model, which is just the original cost minus all the amortization you've recorded so far, or they can use the revaluation model, where they adjust the asset to its current market value. That second one sounds great, but there's a huge catch. You can only do it if there's an active market for that kind of asset, which for a unique internally built project is almost never the case. All right, we've been pretty deep in the accounting weeds here, so let's zoom out. Why should any of us care about these specific rules? What's the big picture? The reality is, for the biggest, most influential companies on the planet today, their true value isn't in their factories or warehouses. It's locked away in their code, their brand recognition, and their mountains of data. It's almost all intangible. And these rules we've just walked through, they are the bridge. They are the system that translates a brilliant, invisible idea into a hard number on a financial statement, a number that investors, analysts, and managers can actually see and use to make huge decisions. It's what makes the invisible investable. So the next time you're looking at a company's annual report, don't just glance at the physical stuff like buildings and inventory. Look deeper, because now you know the story behind those numbers. Now you can ask yourself, what hidden value, forged in the fires of research and development, is hiding in plain sight?